Okay, good morning. My name's Adam King. I'm Head of Marketing here at CSS Investments, and I'm here this morning with our Head Analyst, Ravi Lockyer. You may well have seen the news this morning about Rolls Royce and the drop in the share price that's been that's come off the back of the recent profit warning. So I thought we'd ask Ravi some questions about it. So a lot of people are going to have, well, maybe a lot of people have Rolls Royce in their portfolio. It's a well-known stock. What do you think? What's happened?
Okay, well let me take you through what's happened today, if I may. And I'll start with some context. Today is a sort of third profit warning from the defence sector, aerospace sector in the last month. Kicked off with Chemring, then Meggitt, and now today Rolls Royce. And there are a number of factors today that are specific to Rolls Royce, but there are a number of factors as well that I think are at work that are relatively negative for the sector. Notably, there is far less willingness on the part of buyers in the Middle East and in a number of other countries, Russia, Mexico, Canada, Australia, and elsewhere, to buy heavy goods and defence items. So this is a factor at work, I think, affecting everybody. And today Rolls Royce has updated the market with the news. Two things have happened today. The 2015 guidance has been altered, and the 2016 guidance has been altered. In respect of 2015, the numbers have been moved lower. In the respect of 2016, they've been moved substantially lower. So in respect of 2015 first, the earnings guidance has been lowered to between 55 to 62 pence, with the comment that they'd be nearer the bottom end of the range. And they've itemised a number of factors as well that have impacted the balance of this year. Typically, this is that profits have been moving lower consistently in a number of areas that they're in. In respect of 2016, they've highlighted other details that will be explained in more depth at a capital markets presentation on the 24th of November, when the company will detail an operating review. But they have itemised around £750 million of what they call profit headwinds in respect of 2016. The company makes around £1.4 billion per year in terms of profit before tax for 2015. So this is really about half of the profits this year won't be there next year. That's what this announcement today is saying. So really quite a serious adjustment in the business. A very large restructuring is underway. The company has a new chief executive officer, which is obviously important. New CEOs tend to want to rebase people's expectations, lower them a bit, so that the company can then more easily beat those forecasts. So a new CEO has come in and has concluded that the forecasts for the company need to be moved substantially lower, and that's what's happened today.
So looking ahead then to next year, you mentioned the numbers, you mentioned sort of things happening, but on a normal sort of day-to-day sort of more layman, I'm more of a layman, that, Ravi. So how would you explain sort of what Rolls Royce needs to do next year to sort of put things on an upward turn again?
Most of the time when companies see revenues and profits falling, they engage in cost reviews to reduce costs, to get costs back in line. This is the first job that they'll be doing, reducing overheads as fast as possible. They have flagged that they will do this, and they've flagged around 115 million in aerospace and marine of savings that will be implemented by financial year 17, which of course won't help in 16, but they will help in 17. They have moved down to an area where they're no longer generating free cash flow. That means the company is not generating cash any longer. It is spending what it is receiving internally, and it is not generating any net cash. It's not generating equity. In circumstances like this, and the company has said as much today, the company will review shareholder payouts, which means that there's likely to be a very sharp adjustment to the dividend if there is a dividend.
Okay, so we could see things still sort of continuing in the way that we've seen this morning, and it's more of a potential longer term recovery, looking into next year, maybe not even seeing the full effect of the new CEO and all the measures taken. Looking really into 17, 18 and beyond. Is that a fair reflection?
Well, typically when restructurings of this nature happen, there is a shock event. That's what's happened today. There is a plan put in place that will be in place by the 24th of November. And over the course of the next year, you'll see the business start to adjust to the new conditions, with restructuring charges being booked during next year. So what hasn't been detailed today specifically are the costs of the restructuring next year and the extent to which that may or may not make a difference for 2017. But it's clear that I think we have at least a 18, possibly 24-month wait before the benefits of next year's restructuring are apparent.
Okay, well, thank you, Ravi. It's obviously big news. Everybody knows Rolls Royce. So, I mean, any of you guys out there that do hold Rolls Royce, for example, in a portfolio, or any questions, do feel free to give us a call, visit our website, contact us there through there, or drop me an email on editor@css-investments.com, and we can put you in touch with someone that could potentially help you.